Today's overlooked stock is a big decliner, but it was recently a big winner. Samsara, ticker IOT. George Tillis going to rummage through the rubble to see if we can find something. George, what happened here?
There's a lot going on with this stock, OJ. It's actually a pretty interesting one to start off with. I mean, it's an application software company. It's the IoT stands for basically its benchmark, which is Internet of Things. It basically is an equipment manufacturer and fleet management software company. So everything from large enterprises, AI-driven fleet management solutions, telematics, and it's utilized across multiple industrial applications and commercial applications, from things like manufacturing and transport, warehouse and logistics. It's a growing company, and in fact, their AI-driven platform is one of the leading competitors in this space. They generate about $1.5 billion in sales per year, $23 billion in market cap. And one of the things about this industry space, from an AI-driven standpoint, it's becoming more competitive. And there's actually a company I found that competes with them, and that's Verizon. I was interesting enough. So with that said, if you just look at the stock in the last year, it's fallen the last 2 weeks tremendously. It was trading over $60, now trading around $35. So for what it's worth, there's a multiple compression happening here. Yesterday, the company also reported earnings, and if you look at it from a top-down view, is actually pretty good. They reported 11 cents on an adjusted basis. That was higher by 175% compared to last year's 4 cents, as well as the estimates, which, again, they beat by about 4 cents. The other thing is that their sales number came in higher than estimated, 25% year over year. Their guidance actually improved on a fiscal year basis for 2026 to a non-GAAP profit of 33 cents versus 28 cents. And their inline revenue for this coming year is about $1.53 billion, and that's higher by about 26% on a year-over-year basis. So I think a couple of things are happening here. First off, there was another additional decline because of the earnings report. Even though they increased their adjusted earnings per share for the current fiscal year, they came in line with sales, and sales are actually decelerating. They were around 35% per annum on average over the last 5 years. Now they're expected to decline to 26%. But the thing about it is if you look at the EBITDA growth, they're expected to grow their EBITDA by 140% coming up this year. So I think what's happened here is this is obviously a growth stock. It's a growth stock that got caught up in the AI push, particularly at the end of last year, the beginning of this year. But at the same time, what's happening here is the company's earnings are expected to grow. Prices come down dramatically, more in line with forward earnings estimates. So we're seeing multiple compression occur in this growth stock. It's not necessarily a business challenge, not necessarily a business issue or an issue with their technology. It just comes down to, as you're well familiar with, that stocks can certainly move parabolic to the upside and, of course, retrace significantly to the downside, and that's what we're seeing here in this name.
Okay. Well, retracing the downside, some people call that opportunity. After a long trend, It still looks decent after 2.5 years. So I think a good one, an appropriate one to hit. As we do know this week, too, earnings reactions were pretty harsh. Thanks, George.